People are freaking out about inflation again. Things really kicked off last week when CPI, the Consumer Price Index, which measures basically the average price increase of a basket of goods and services that households purchase, jumped by more than expected, which could be indicative of some inflation, which I think everyone pretty much agrees upon. From Jerome Powell to Michael Burry, everyone agrees that there's going to be some inflation. At least there's some overlap there. Now, how long this inflation will go and how high it'll go, that's where the disagreement starts seeping in. However, the problem with economists and just people in general, I guess, is that they disagree even on the most fundamental of things. Economists notoriously disagree over fundamental ideas. How much should people be taxed? How big should the government be? How should welfare be implemented? What are the effects of unemployment and high inflation? As a result, it means me, a little donut over here, can be stuck between two Goliaths, Jerome Powell and Michael Burry, look at both of them and go, they're both way smarter than me, but Jerome Powell thinks that this inflation that we're seeing is going to be transitory, it's temporary, it's something that's going to happen as we slingshot out of the brink of a recession, but things will recover, while Michael Burry is saying, no, this is pretty comparable to post-war Germany. We're going to see hyperinflation and start using money as wallpaper. And when you're stuck in between these two behemoths with big old brains, you look at each one and go, how am I supposed to decide? Whose side do I pick? If you look at it from a logical perspective, what happened when we went into lockdown? Well, demands for goods and services dropped. Okay, we were all staying at home. We didn't have much money. We were clinging on to every dollar we had. Okay, and some businesses weren't even open, so you couldn't even go spend money on stuff. So demand went down. If demand goes down and supply stays relatively the same, then you're going to have a decrease in prices, which happened in some sectors, but also supply did drop as well. There was supply shock because the supply chains were all messed up, so supply decreased as well. So you had some areas that had prices increase, some areas that had prices decrease, some that stayed relatively the same. It all depends on how the demand and supply curves shift, right? When we're looking at the supply and demand, on the y-axis we have price, on the x-axis we have quantity. We could be looking at one good or service, okay, it could be chocolate bars, or we could be looking at aggregate demand and supply and demand for the overall economy. If we draw the demand curve, it looks something like this, where at prices that are very high, people are going to be demanding a low amount of goods and services. This is a quantity demanded. They don't want to buy a bunch of stuff when prices are high. Prices are low, quantity demanded is going to be high. And then we can draw the supply curve in here as well. When prices are high, the amount supplied is going to be high. People are going to want to sell a bunch of stuff at high prices. When prices are low, the amount supplied is going to be low. People don't want to supply or sell so much at low prices. Right here, where these two lines intersect, we have market equilibrium, where the quantity demanded and supplied is equal, and the price demanded and supplied is equal as well. So that's where the sellers and buyers can shake hands and the deal is actually made. When the lockdown happened and demand shifted to the left, what happened to prices? Well, right here, when our previous equilibrium, our prices were right here. This is the previous equilibrium, the price equilibrium, before lockdown happened. Then demand decreased. Okay, so even for the same price, the amount demanded was less. Okay, this is the initial quantity demanded. And then when demand shifts to the left, even at this price, people demand less. So quantity demanded decreased. So when demand shifted to the left, we have a new equilibrium down here, where prices decrease as well as quantity demanded and supplied decrease. But supply also went down as well, right? Because the supply chains were all muffed up. So when that happens, the supply curve shifts to the left as well. And now our equilibrium has moved from here to here, and prices have remained the same, while the quantity of goods and services has gone down. Now, if supply shifts even further than that, so our equilibrium goes from here to here to here, prices will increase because demand is now higher than supply. So you see that prices have gone up. So in some areas, supply decreased more than demand. Demand was more than supply, or vice versa. So prices were shifting around in different areas. Overall, through 2020, looking at the personal consumption expenditure, which is a good way to keep tabs on inflation had gone down. Okay, because there was both a demand shock where demand went down, but supply also dropped drastically, which if it dropped more than demand, then you could see prices decrease. Okay, so now what's the problem? What's the problem then? Why are we concerned about inflation? Well, it's because of the trillions and trillions of dollars that is being pumped into the United States economy. That easy money means that demand is going to increase. And if demand increases while the supply chains are still pretty muffed up, you're going to see an increase in prices for goods and services, which is an increase in inflation. And if that happens and starts getting out of control, if we start slingshotting really hot out of the brink of a recession, then the Jerome Powell, the Federal Reserve, is going to have to increase interest rates to combat inflation. Increasing interest rates makes it harder to borrow money. If it's harder for everybody to borrow money, then it's harder for them to spend money. If it's harder for them to spend money, there's less demand, prices go down. Inflation goes down. It's also not so great for businesses either, because companies, they can't borrow money and invest in different ventures and stuff. And also consumers don't have access to as easy money to buy their goods and services, which is also great for businesses, great for stock prices. So that's why you're seeing the stock market dip a little bit, is because people are a little bit concerned about inflation being a problem and Jerome Powell increasing interest rates before his 2023 target. As you know, they've been pretty close to zero for quite a while now. This also doesn't bode very well for any of Biden's infrastructure plans, in my opinion, because it's not going to be very popular if inflation is a concern of the public majority. So that's the Michael Burry side of things. He sent out a series of tweets that he since deleted, talking about how hyperinflation is going to be a problem because we've never pumped trillions and trillions of dollars into the economy in such a short time, and we're going to slingshot it out of this so fast that hyperinflation is going to be a huge deal. And he made comparisons directly to post-war Germany and when they were making wallpaper out of money. Jerome Powell, on the other hand, is saying that, no, this is transitory, it's temporary. Yes, demand is going to increase as there's a lot of stimulus and people have access to easy money and as interest rates are low, but the supply chain is going to be fixed. Okay, everything's going to be back to some sort of normal, all right? Supply is going to increase. It's going to shift the supply curve to the right to match the increase in demand, which is going to level out prices. So he's saying it's transitory. Plus, he's also noted that we've been below our target inflation rate of 2%, for several years. So being over that target rate isn't such a big deal either. So who was right? Who was right? Jerome Powell or Michael Burry? Those two schools of thought. The economists who think it's transitory, that are very smart, or the very smart economists that think it's not transitory and it's going to be a severe issue. How do we know who to believe? You don't. It's a probabilities game. The odds of super impactful inflation could be 30-70, 50-50, 70-30. You don't know until it happens. And that's why there's so much disagreement on it. And it's also kind of hard to model inflation super accurately. So what could you do? Well, you could hedge. You could hedge using futures. You could sell covered calls. You could buy insurance companies because they tend to invest a lot of cash that's lying around into fixed income securities. You could buy bank stocks that tend to do well during high inflation. Or you just like me and you just ride it out. You buy the dip, you like a company, you stick with it. I'm not going to go find some insurance company that I don't understand because I don't understand insurance. Okay, I took a class on it. I tried to be an intern at a life insurance company. I couldn't pass the damn test to get into the internship. Okay, I don't understand insurance in the slightest. I'm not going to go find some insurance company and buy it just as a hedge, even though I don't know the company at all. I'm going to buy companies that I know that are within my sphere of competence. I'll buy if it goes red, and I'll buy if the stock market drops 50% because I don't give a shit. That's why you don't put all the money you ever have into the stock market, because if it drops 50% because things really go haywire, you're going to lose your damn mind and you won't even be able to buy the dip. I'm along for the ride. I'm a passive guy just sitting here just buying stuff when I see fit and just watching what happens. How the hell could I possibly determine if inflation is going to be a significant problem if a smart guy like Jerome Powell and a smart guy like Michael Burry and smart guys and gals that are economists that have the opposing viewpoints on inflation are in direct conflict with each other? How am I supposed to assume that I can supersede them and I actually know what's going to happen? I can't. And I don't want to hedge because I'd rather just buy the dip. So at the end of the day, when it's a probabilities game like that, when you don't know whether it's transitory or if it's going to be hyperinflation or whatever, you just stick to what you know. And what I know is buying the damn dip. I know that I should have money saved up. I should know that I should be able to handle a 50% decrease in the stock market. If the S&P 500 drops by 50%, it shouldn't absolutely ruin me. Yes, I might cry into the pillow at night, but I'll still be able to get up in the morning and have an okay day. I won't have to go live in a cardboard box. Am I going to try to speculate to the downside? No, I'm not going to try to speculate to the downside. Look at the S&P 500 over the last 100 years. Why would you ever speculate to the downside? Some of you guys might be going, well, because I'm making tons of money right now. I don't care. It's possible to make money. Bears make money, right? Bulls make money, pigs get slaughtered. I'm just saying it's easier for bulls to make money than it is for bears when the stock market in general goes up more than it goes down. So my investing strategy remains the same. Obviously, this is something I've never experienced. I wasn't there for the hyperinflation or runaway inflation of the late 60s, early 70s. I don't know what that personally feels like, and maybe I'll become more intimate with that idea in the future if Michael Burry is correct. But for now, when things are up in the air and big minds are in direct conflict with each other, I'm just going to stick to my guns and not do anything rash. When people compare our situation to the late 60s, early 70s, they don't take a look at the differences. Back then, the Federal Reserve took forever to increase interest rates, which really made the problem worse. They tried to fight it through taxationary measures by basically taking money out of people's income and reducing government spending in an attempt to decrease inflation. Didn't really work. They waited quite a while and then finally started increasing interest rates. What was it, when the new chair of the Fed took over? I don't remember. This time around, I don't think the Fed would make that same mistake. I think they would snap interest rates up quite hard if they had to, which doesn't really bode well for the stock market, but if it means that we can keep the economy at least on some level of an even kilter, then so be it. And if rates do snap up and we've priced in low interest rates to 2023 and all of a sudden 2022 or 2021, interest rates go up and we have to see that price discovery, that correction to the downside, because all this time we've been pricing in 0% interest rates until 2023. So be it. The market takes a dip. Guess what I do? I buy. I'm a simple man. If you want to follow me on Iris and see exactly how much my portfolio is getting absolutely wrecked, you can do so down below. You should check it out. You can see all your friends' trades and stuff. It's pretty sweet. Right now, you can only see my Leaps portfolio, and you can see a meme portfolio that's just Microsoft calls. Pretty soon, though, you'll be able to see all my money because I'm going to have all my investments linked into Iris. So you'll be able to see everything I do real time. For real. Complete transparency. Sign up for Webull, deposit $100, you get $3,400 you can get up to $3,400 of free stocks. That's it. Thanks for listening to me ramble. I love you. Catch you later.